Yes, so good evening. So I'm Christopher Darby from Dab Hand Accounting. I've met quite a few before. It's great to see you here tonight. We're into spring, things are improving. And I'm going to talk to you about some topical issues this evening. But first off, for those people who are guests here or visitors to YBC for Mega Networking, I want to talk to you why I joined YBC. So originally, I joined for the networking opportunities. I went to a couple of meetings, and then I think I joined after the first or second meeting. I can't quite remember. That was sort of nearly 2 years ago now. Amazingly, back then we could actually meet people in for real, not over a screen. And I was impressed by sort of how nice people were. It was a very pleasant way to network. I did a couple. Ted asked me to do a couple of talks, and took some people on as clients from there. But actually, what I've really found with YBC it's useful is the business services. For example, the tax helpline that's included in your subscription. I use that to ask for information. I've actually found it better than many other tax lines that are actually provided by accounting outfits. And the other thing that I have joined for is the tax investigation insurance. So a lot of people don't realise that tax investigations are increasing in numbers. Revenue and customs are recruiting people in order to do these. And the average investigation costs about £5,000 and lasts 18 months. £5,000 actually is the least bad of those two. It's the 18 months of stress of dealing with HMRC. And HMRC deliberately asks questions to see if you say, oh, it's X, Y, Z, so that it can wring extra tax out of you. But having the investigation insurance, if I'm your accountant, you just pass the problem to me and I deal with HMRC on your behalf. You don't pay anything further because the insurance and all the costs of being with YBC are tax deductible in whether you're a sole trader or a company. So that's nice to have, especially with corporation tax going up, which we're going to talk about in a minute. And I'll just say thanks to Mia and Ted again for inviting me to speak tonight. So for those of you who haven't made your minds up, yeah, YBC offers you some great services, and I've only covered a couple of those. There's some really good stuff out there. So if I just go on to so as I said earlier, you may have heard me say an accountant isn't just for Christmas or year end. A lot of people have an accountant who they speak to only once a year to do their tax return and the company accounts, maybe their personal tax return. Here at Dab Hand Accounting a few years back, I thought I want to give a lot more to my clients than just the compliance services you expect with an accountant. So I've talked about a couple of them earlier, but we help a number of small businesses do the sort of things that people only necessarily associate with big companies, such as helping them hold board meetings to think about strategy, ways forward, ways of improving their business. And we've just helped a client by linking them up with a marketing guru who's going to help publicize and market to really good products that they said we don't really know what to do with them, but I'll put them in that direction. So that's an example of what we do. So sort of in summary, what we do is we believe you have better data. So if you have good accounting records, good bookkeeping, that leads to better level analysis. That goes on to you making better decisions. Better decisions lead to better results. They lead to a better business, a better life, and ultimately throughout we have a connection with a charity, a better world. So if we're all making more money, we can help each other as a community that much better. So those are our values and philosophies. So how do we help our clients? As I say, we have services that people often only associated with going to PricewaterhouseCoopers or a large firm are going to charge you thousands of pounds for, totally unaffordable. So just an example of some of the things that we're helping the clients with. We have a benchmarking service which compares you with your competitors and shows you how you're performing and shows how much you could make if you got, say, if you're in the lower tier up to the next tier and beyond, and practical suggestions for implementing things. The board meetings we've discussed. And then performance measurement. How do you increase the value of your business and improve your work-life balance, for example? There are a number of things that we can do there. In that space, a lot of small businesses assume, a lot of small business owners assume, oh, well, I'll be able to sell my business for a song and I don't need to worry about my pension. Well, actually, that's often not the case. What you need to be doing is improving the performance now. And actually, that will enable you to pay into a pension and other things and give you your time back. We also unique is that we offer a money back guarantee. And I know we had one of the action coaches talk about this. So where you're on a monthly sort of easy thing under fixed price agreements, if we don't perform to your satisfaction, you ring me up and say, Christopher, I'm not happy with how we've been this month. I want to reduce my monthly payment next month to, yeah, fine. And we then issue that credit note to you. Okay, so one of the main meat of the matter is forthcoming tax changes, and particularly obviously in the light of the budget that we had last week, and some things you probably need to start thinking about now to help you sort of avoid some of the big changes that are coming through. So we had a budget a few weeks back. And the things that are coming out of that is that pretty much now, as the vaccination program sort of proceeds and it's going pretty well, you know, come September, October time, the furlough scheme is going to end. It's most unlikely to be extended unless there's another lockdown, which hopefully there won't be. That will be the end of the coming to the end of the subsidised loans, the CBILS and the bounce back loans. I think you've still got a few days to get one, and if you haven't taken that bounce back loan, do so. You can. Big news, of course, is tax increases are coming, and we have effectively unaffordable government debt related to both spending pressures from the promises that are being made to increase spending on the NHS, schools, everything else, and an ageing economy, which is increasing the pressure on pensions. And then there's the uncertainty still to come from Brexit and the new trade deals that are going to be made in due course. A lot of people don't know we've actually met trade deals have been made. The big one was with Japan, which is more comprehensive than the deal they had with the EU. We've rolled over the customs agreement with Turkey, and there's been a deal with Albania. But the sum total of these is it does not yet offset what actually is being lost on the side. So in terms of what the tax increases that are coming, there was a pledge made: we won't increase national insurance, won't increase VAT, we won't increase income tax, which are the three easiest ways to raise money for the government. So we had the old corporation tax and a thing called fiscal drag, which basically means by freezing the allowances of a taxation, it means that more people are brought into paying tax, including if you've just had a 1% pay rise if you're a nurse. So the elephant in the room, as I put on here, you may wonder why there's an elephant, but there is an elephant in the room, is unaffordable government debt. Which is going to have you might think, oh, well, it's not my problem, but it's going to be all of our problems, because the only way it's going to be, there's two ways it can be relieved. It can be either relieved like the Germans did in the 1920s and had hyperinflation, and that didn't end very well for the world a few years later, or the government has to either increase taxes or cut spending. And the latest government paper is that it's going to almost certainly be both. So here's the frightening slide. This is from the government's own measures. This is showing the blue lines are showing you how much borrowing is going up, and how much it was compared to the previous year. And even that year, borrowing was rising again, having fallen since 2010. So that's back on the up. And the expected outturn is going to be around £300 billion, which is about 15% of the national income. If you tried to borrow that off your bank manager, he'd probably say, certainly for small business, we know what the answer would be. So that's kind of the background to what's going on. So the big thing that is coming through, not this year, so it doesn't affect this tax year, it won't affect the next tax year, but it's going to come in from the 6th of April 2023, is the corporation tax change and the freezing of the allowances. So that means if your income is going up, you're going to be paying more tax than you would have done anyway. So effectively, they are using what is also known as financial repression to bring more people into the tax net. And as we was in the news today, so I said, if you thought the austerity the last 10 years was bad enough, just wait until the bills start coming in. So one of the things you want to be looking at is if you're going to be dragged into 25%, which would be, people might think it's a nice problem to have. You're only going to have that on profits in a company. over £250,000. I'm just giving you an example, just in case you know people who have, got a really sort of successful business, which does sort of make huge profits. The effective change that they're going to have once you hit if we say they earn 260k of profits, they're going to pay the 25% on the amounts over 250. So it would be, say, £10,000. Currently, they would only pay £1,900 of tax, 19%, and then they would pay the dividend tax, which would be about £3,000. They'll be paying nearly half of their income, or half their earned income in tax. But from just over a year's time, that's actually going to go up to 54%. But they're going to be paying directly 54% in terms of corporation tax and income tax. You're paying 54% of those profits straight over to the government, and that's going to be fairly onerous. Now, the thing that hasn't been, the thing where you should sort of be thinking about this for these sort of, is potentially whether actually it's best to go back to being a sole trader, because as it currently stands, they would pay 45% of that if they were sole trader, being 4.5% plus 2% national insurance. So their effective tax rate would be 47%. So there's a 7% difference potentially, unless there are further changes to be made, which I think there will be, between paying corporation tax and being a sole trader. So if you recall, a few years back, lots of people incorporated to avoid the higher charges on the self-employed, but actually that looks like it's going the other way. Now, it still actually impacts if you're on the 20% rate, because if you're on the 20% rate and you're paying the additional rate, the 45% tax, you'd be paying the same amount, 45 plus the 2%, as a sole trader. But you'd actually be left with £300 less if you're incorporated. So if you think that potentially those things are coming around, then it's worth thinking about your status, not necessarily not for all your business, but potentially for part of it. So what can you do? So you've probably heard about the super deduction that there will be for capital items in this tax year that's about to start on the 6th of April, which is, just in case you've forgotten, that's actually Bank Holiday Monday. So the last few days of this tax year, things are going to be closed, which I'll talk about in a moment. What can you do? If you haven't paid into a pension and you've got profits that you can use, then a pension is still an excellent tax delay scheme, tax avoidance, a legitimate tax avoidance scheme. When you pay, so you can get full relief in your company for paying into a pension. That goes straight against your corporation tax. So going forward, if you do hit the 25%, that's a great way to bring yourself under there. So with a pension, you can put 40k a year into that. And if you've been a member of a pension scheme before, and you haven't contributed recently, you can bring forward 3 years. So potentially you could put 160k in 1 year if you haven't contributed recently. The other thing to look at is what some of the small businesses do is they don't actually look at whether there's work that they're doing that they haven't yet billed for. They're not able to bill for it, but they've done work on it. And you can actually put into your account an adjustment that basically brings forward income. And that would then be taxed at the lower rate of tax, the current 19%, rather than potentially at the higher level. And the other thing is delay cost, so that you actually, if you can, you push expenditure items into the next tax year legitimately, so that you're then reducing the amount of tax you are paying tax a bit earlier, but you're paying it at 19 rather than potentially at 25%. Again, the super deduction, that's only going to, the value of that is 30% extra. So if you buy a computer for £1,000, it's going to save you £30. So it's not going to really benefit sort of smaller businesses. But it's still worth looking at if you know people who've got large businesses, at looking at that to get that super deduction, which will only be temporary, that adjustment. The other thing to think about, and it's worth thinking about way before your profits sort of hit that high mark, is a holding company. What that is for most people is they incorporate a company and they become the chief shareholder. What you can actually do and what that means is that when you tend to get assessed on all your income in one go. With a holding company, you can hold monies that you don't need to draw out of the company, and that then will not pay corporation tax until you sell that investment or sell what's in there. So that's a good way of delaying the point at which you may be paying the 25% or the 20% or whatever your marginal rate is. The other thing that's worth looking at is essentially increasing your salary that you pay yourself rather than dividends, because if you have employees, then you can avoid paying employers' national insurance up to the £4,000 mark, and that means that you can effectively earn more salary before you start paying the higher amounts of national insurance and income tax. You utilise your personal allowance through salary. That also is worth thinking about if you think you might be caught by IR35. So I had a chat with an ex-revenue inspector some years back, and it says, if you legitimately increase your salary, your director's salary, then when it's looked at, if it goes up to £15,000, then you're less likely to be inspected. And if your salary is the the 8.5 or 9.5 standard amount that's recommended, you're going to be above that. So that reduces your that's worth thinking about too. The other thing, as I said, is whether you should consider a partnership or a sole trade for part of your business, if you can segment that out so that you avoid those higher corporation tax charges. So there are a number of things that you can do, and I'd like to talk to any of you about the sort of things that you should potentially think about. There is time to plan for this, which is why I predict that there may well be an election within the next 12, 18 months, and then we will then see the higher rates of VAT and income tax, because as I think you can see, there are quite a lot of ways in which you can voluntarily reduce your corporation tax bill. So we'll open up for some questions in a few moments on that. But just some quick reminders. This year, the tax year ends on Monday, the 5th of April, which is Easter Monday. And the Friday the 2nd is a bank holiday for Good Friday. So if you haven't done an ISA yet, and you need to get hold of cash or transfer investments in, then this is kind of like these few days the last chance for you really to do that. And you might say, oh, the rate of returns on ISAs aren't great at the moment. That is true if you go for a cash ISA. However, if you're looking long term and have more appetite for risk, then you might want to think about stocks and shares ISA, because those have done, over the longer term, they generally have a higher rate of return than bank accounts, which are more safe. Again, the pension, have a look at that. YBC have got solo pension, so it's something that is really useful, because quite often pensions want you to pay in £10,000 at a time, or have quite ruinous investment charges. There's now the solo pension through YBC, which has a lower rate, which you can put money aside into as a more convenient rate. Because again, a lot of business owners just do not have any form of pension provision, and that can mean that when you need to retire, or you can't continue working, that you're dependent only on the state pension and the pension credits, and that can make life not particularly easy. So those are the main points coming out of the budget. So have a think about what you where you're going business wise. There are opportunities out there, and as these releases are withdrawn, there are going to be some great opportunities in the economy coming out on the other side. And I've been talking to clients about those, and we'd be delighted to talk to you with YBC members or guests about how potentially we can help you. So my email's there, and I'm now open to any questions that may arise.